Ever wondered how consolidated financial statements are prepared according to IFRS 10? Well, you're in the right place. IFRS 10, or International Financial Reporting Standard 10, provides a guide for the preparation and presentation of these crucial documents. It's all about identifying who's in control. That's the parent entity, the one that has the power to govern the financial and operating policies of one or more other entities, known as subsidiaries. It's a bit like a family tree, but for businesses. This consolidation process involves assessing whether the parent entity has the power to direct relevant activities of its subsidiaries, activities that significantly affect their returns, and it doesn't stop there. The parent entity's exposure or rights to variable returns from its involvement with the subsidiaries are also closely examined. Understanding these foundational concepts is key to mastering the consolidation process. How does a parent entity exert control over its subsidiaries? This question lies at the heart of IFRS 10. Control is the key criterion. It's not just about having the majority of voting rights. It involves the power to govern the financial and operating policies of an entity. This brings us to the concept of relevant activities. These are the activities that significantly affect the subsidiary's returns. Now you might wonder, what does power to direct relevant activities mean? Well, it's the ability of a parent entity to guide the direction of a subsidiary's business. This power can manifest in various ways, such as setting strategic policies, appointing key management personnel, or making significant operating and capital expenditure decisions. In essence, a parent entity has the power to direct relevant activities when it can steer the subsidiary's actions towards achieving its own objectives. So, control is not just about ownership but also about the ability to guide the direction of the business. Now, what do we mean by variable returns, and how are they linked to the parent entity's power? Let's talk about variable returns first. In the context of consolidated financial statements under IFRS 10, variable returns are essentially the benefits that the parent entity stands to gain or lose from its involvement with its subsidiaries. This could be in the form of dividends, interest, royalties, or even changes in the value of the subsidiaries themselves. Now, it's not enough for the parent entity to simply have exposure to these variable returns. The key question is whether the parent entity has the right to these returns. It's the rights to these returns that could signify control, and control, as we've discussed, is the magic word when it comes to consolidation. But having exposure or rights to variable returns is just one piece of the puzzle. The parent entity also needs to have the ability to use its power over the subsidiaries to affect these returns. This is where the link to power comes into play. Imagine this. You're a parent entity and you have the power to direct the activities of your subsidiary. You're also exposed to the variable returns from your involvement with the subsidiary. But if you can't use your power to affect those returns, then that power is, in essence, useless. So, the ability to use power to affect returns is a critical link between the power of the parent entity and its exposure to variable returns. It's this ability that can truly indicate control. And why is control so important? Well, it's this control that determines whether the parent entity needs to consolidate its subsidiaries. If the parent entity has both the power over the subsidiary and the ability to use that power to affect its returns, then consolidation is necessary. This link is crucial in determining whether consolidation is necessary. Remember, the application of IFRS 10 requires careful judgment, taking into account the specific facts and circumstances of each case. It's always a good idea to consult with a professional if you're unsure. What other factors do we need to consider in the consolidation process? As we delve deeper into the consolidation process, it's essential to recognize that there are other considerations that come into play. One such factor is potential voting rights. These are rights that, upon exercise or conversion, give an entity the power to direct the relevant activities of another entity. They are a crucial consideration in assessing control. Additionally, potential voting rights held by others, protective rights, and other contractual arrangements can also influence the consolidation process. For instance, a parent entity may hold rights that, when combined with its voting rights, give it the ability to govern the financial and operating policies of a subsidiary. Conversely, protective rights held by others can limit the parent's control over the subsidiary. Further, contractual arrangements can also affect the consolidation process. For example, a contract may grant an entity the ability to direct the relevant activities of another entity, thus establishing control. Hence, it is important to thoroughly review all contractual arrangements when assessing control. As we move forward, it's crucial to remember that control is not a static concept. It is subject to change, and as such, needs to be continuously reviewed. The consolidation status of entities may need to be revised if there are changes in facts and circumstances that alter the control dynamics. For instance, a change in the ownership structure, a new contractual agreement, or a shift in the market environment could alter the control status of an entity. This continuous review of control is not merely a bureaucratic exercise. It ensures that the consolidation status accurately represents the current control dynamics. It ensures that the consolidated financial statements provide a true and fair view of the group's financial position and performance. In essence, the consolidation process is not a one-and-done task. It requires ongoing vigilance and a keen understanding of the various factors that can influence control. Regular reviews ensure that any changes in control are promptly reflected in the consolidation status. Once control is established, what next? Well, we dive straight into the consolidation procedures according to IFRS 10. The first order of business is to amalgamate the financial statements of the parent entity and its subsidiaries. This is done by adding up similar items like assets, liabilities, equity, income, and expenses. But beware, intercompany transactions and balances have to be eliminated to avoid double counting. Next, we turn to the treatment of non-controlling interests, which represent the equity in a subsidiary not attributable, directly or indirectly, to a parent. Non-controlling interests are presented in the consolidated statement of financial position within equity, but separate from the equity of the owners of the parent. Now let's take a detour and talk about special purpose entities, or SPEs. These entities are designed to fulfill narrow and specific objectives, such as the securitization of financial assets, leasing, research and development activities, or other purposes. According to IFRS 10, an entity must consolidate an SPE when it has control over the SPE, despite not necessarily having any ownership interest. Control over an SPE is often a matter of substance over form, considering not just contractual arrangements but also any implicit commitments or obligations to support the SPE. Lastly, remember that consolidation is not a one-time event. It's a continuous process that requires regular review. If any changes occur in the parent entity's control over its subsidiaries, the consolidation status may need to be revised. This also applies to SPEs, which should be reassessed for control every reporting period. In conclusion, consolidation procedures are a critical part of preparing consolidated financial statements. They ensure that these statements present a true and fair view of the group's financial position. By understanding and applying these procedures, entities can provide accurate and transparent information to their stakeholders, enhancing trust and confidence in their financial reporting. So, let's keep forging ahead, navigating the intricacies of IFRS 10 and mastering the art of consolidation. Proper consolidation procedures ensure that the financial statements present a true and fair view of the group's financial position. How are non-controlling interests treated in the consolidated financial statements? This is a question many accountants and financial professionals grapple with. But let's unravel this mystery together. Non-controlling interests, formerly known as minority interests, are those portions of equity in a subsidiary not attributable, directly or indirectly, to a parent. These interests have a separate presentation in the consolidated financial statements, distanced from the equity of the group. This distinction is vital as it provides a clearer picture of the parent's control over its subsidiaries and the economic benefits it can extract from them. But what happens when the parent doesn't have full control over a subsidiary? The non-controlling interests step in, representing the equity interests in the subsidiaries not attributable to the parent. This could be due to various reasons, like the parent holding less than 100% ownership in the subsidiary, or other shareholders having significant influence over the subsidiary. Either way, these interests need to be separately presented in the consolidated financial statements. Now, let's shift gears and talk about the presentation and disclosure requirements under IFRS 10. The consolidated financial statements must be prepared and presented in accordance with the standards set out in IFRS 10. This includes the disclosure of information about subsidiaries, the nature of relationships between the parent and its subsidiaries, and the impact of non-controlling interests on the consolidated financial statements. These disclosures are more than just a formality. They provide valuable insights into the group's financial position and performance, enabling users of financial statements to make informed decisions. Thus, Transparency in presentation and disclosure is not just a requirement, but a key to providing useful information to the users of financial statements. So, there you have it, a quick overview of non-controlling interests and the presentation of consolidated financial statements. Remember, the intricacies of IFRS 10 require careful consideration and judgment. When in doubt, it's always a good idea to consult with an accounting professional. Transparent presentation and disclosure are key to providing useful information to the users of financial statements. What happens when there are changes in ownership interests? Now that's a question worth asking. In the world of finance, ownership interests can change hands like cards at a poker table. So how do we account for these shifts? Well, under IFRS 10, if there are changes in ownership interests but control is not lost, these transactions are treated as equity transactions. Simply put, it's like exchanging shares in a company. The carrying amounts of the controlling and non-controlling interests are adjusted to reflect the changes in their relative interests in the subsidiary. But what if control is lost? In that case, the parent de-recognizes the assets, liabilities, and non-controlling interests of the subsidiary, and any remaining investment is measured at its fair value. Any difference between the amount by which the non-controlling interests are adjusted and the fair value of the consideration paid or received is recognized directly in equity. Now let's move on to disclosures. They're like the open book of a company's financial story, providing valuable insights into its operations and financial performance. IFRS 10 mandates comprehensive disclosures about the nature of the relationship between the parent and its subsidiaries. This includes information about significant restrictions on access to or use of assets and settlement of liabilities. It also requires a disclosure of the nature and extent of significant restrictions on the ability of subsidiaries to transfer funds to the parent in the form of cash dividends, or to repay loans or advances. As for non-controlling interests, the impact on the consolidated financial statements must be disclosed. This includes the allocation of profit or loss, and each component of other comprehensive income to the owners of the parent, and to the non-controlling interests. Remember, the goal of these disclosures is to provide information that enables users of financial statements to understand the nature of and changes in the risks associated with its interests in other entities. In conclusion, comprehensive disclosures provide valuable insights into the group's operations and financial performance. So, what are the key points to remember about IFRS 10 and the consolidation process? Well, let's take a moment to reflect. We began by understanding the role of the parent entity, which essentially holds the reins of control over one or more entities. We learned how to identify these subsidiaries, keeping in mind that control is the lodestar to navigate this process. Next, we delved into the concept of power to direct relevant activities. This is all about the parent entity's ability to influence the operations and financial policies of its subsidiaries. The crux here is that these activities should significantly affect the subsidiary's returns. Remember, it's not just about having power, but also about exposure to variable returns. The existence of variable returns from the parent's involvement with the subsidiaries could be a telltale sign of control, but it doesn't stop there. The parent entity must also have the ability to use its power to affect these returns. We also explored the vital link between power and returns, which is a cornerstone in deciding whether to consolidate the subsidiaries. Other factors, such as potential voting rights and protective rights, also come into play. Control isn't a one-time assessment. It requires a continuous review, and any changes in facts and circumstances may call for a revision in the consolidation status. Once control is established, we discussed the consolidation procedures and the treatment of special purpose entities and non-controlling interests. Presentation and disclosure of consolidated financial statements in accordance with IFRS 10 were also emphasized. Lastly, we touched upon the accounting for changes in ownership interests and the importance of disclosures about subsidiaries, relationships, and the impact of non-controlling interests. Remember, applying IFRS 10 is not a straightforward task. It requires sound judgment and a thorough understanding of the specific facts and circumstances. It's always a good idea to consult with accounting professionals for specific guidance in applying IFRS 10. Thanks for watching. Don't forget to like, share, and subscribe to Corporate Canvas for more informative videos like this one.